Good morning and welcome to the second Aristotle Capital Management Webcast. My name is Steve Borowski. I'm the president of Aristotle and I'll be your host for this morning's conversation. During our first webcast, we focused on the underlying pillars behind what we do at Aristotle. The premise that the way that we're going to add the most value for our clients going forward is to own good, high-quality, well-managed, world-class organizations that sell at a meaningful discount to our estimate of its true intrinsic value, with some events, some catalyst, something on the horizon that we can identify that we believe will allow the market value to catch up with our estimate of its intrinsic value within a realistic time horizon, which for us is typically about 3 to 5 years. Much of that first conversation had to do with the domestic strategy, value equity. Today's conversation is going to focus on our international strategy, and joining me for that conversation are the co-portfolio managers of the international strategy, Sean Thorpe and Geoff Stewart. Thank you, guys.
Thank you.
If you would take a few minutes and discuss the process, the methodology, the implementation with regard to international and how that may coincide with other strategies here at Aristotle.
Absolutely. Thank you, Steve. The international strategy is actually identical in philosophy and process to all of the strategies of the firm. It just uses a different universe. Our universe comprises 1,400 companies domiciled outside of the United States, and about 10 to 15% of those will ultimately be eligible for investment, given our rigorous philosophy and process and how we look at companies. I'll jump into that now, but it's based on 4 key principles. The first is investing in high-quality companies. It's investing from a global perspective. It's taking a long-term view, and it's constructing focused portfolios. So first, I'll start with high-quality companies. The companies we seek to invest in are companies that provide their products or services, and that those products and services are bought for reasons other than price. They typically have structural competitive advantages, or what we like to call wide moats. They're high-quality businesses, and by investing in these high-quality businesses, we believe we manage and mitigate the downside risk. And what is critical to this whole process is these companies have a return on invested capital that exceeds their cost of capital, or at least a clear path to get there. The second part is that we invest from a global perspective, and this is critical because over the last couple decades, you've seen the world has become much more global in how people compete. It comes from many different regions, and for example, we own Heineken in the international strategy. You can't make an investment in Heineken without understanding what Belgium-based InBev has been doing, or SAB Miller out of the UK. It's critical to really analyze these companies from a global perspective. Thirdly, we take a long-term view, and a lot of our competitors talk about being long-term, but they really aren't. We hold our investments, and we seek to hold our investments for at least 3 to 5 years. That's from the outset. And you can see this is demonstrated by our annual turnover, which has been 22% since inception. So it's very, very low turnover, very tax efficient. Lastly, we construct focused portfolios, and we really do stay focused. We own between 30 to 40 companies at any given time in the portfolio, which allows us to really understand each and every company that we own, and at the same time, it provides sufficient diversification. Because having that number of companies across different industries, sectors, and geographies provides a level of downside risk that gives us comfort. And with that, let me hand over to Geoff, who will walk you through our investment process.
Thanks, Sean. Our investment process consists of 3 primary tenets. The first is that we seek companies that have the characteristics of quality that Sean just discussed. And we have found that over time that the companies we tend to invest in have long operating histories, in which they have showed a consistent ability to maintain, if not improve, their operating margins and their free cash flow. We also have a preference for companies that have strong balance sheets. Now, this isn't to say that we don't invest in companies that have leverage, but we are very focused on making sure that companies have an appropriate capital structure, one that will help them maximize their return on equity. And then last, but certainly not least, is management. I mean, as long-term investors, we consider management teams to be our business partners. And so in that way, we want to make sure that they recognize the same quality attributes in their business as we do, and that they have a strategy to strengthen those attributes over time so as to build shareholder value. The next component is valuation. If we've identified a company that we deem to have high quality attributes, we then want to make sure that it is trading at an attractive valuation. And an attractive valuation to us means that the company is trading at a material discount to its intrinsic value. We really take a private equity approach to public markets, meaning that we take a longer term view, and we focus much more on operating fundamentals than we do on macroeconomic factors. It's crucial to understand that we also normalize operating results, and we do that so as we get a true understanding of a company's earnings power. And this allows us to take advantage of short-term inefficiencies in the market, which can happen over longer economic cycles. Once we've identified a company that's high quality and has an attractive valuation, we then seek to identify the third component of our investment process, and that is what we refer to as catalysts. Now, this is a word that is commonly used, but is not commonly applied. What catalysts mean to us is that there is some factor that over our investment horizon will close the gap between the company's current market price and its long-term intrinsic value. Now, we don't claim to have some sort of special insight into future macroeconomic factors or corporate events, but what we do have is patience. And as Sean mentioned, in today's world, although many investors say that they have a long-term view, they really don't. And it is our long-term view that allows us to assess catalysts and get a true understanding of their impact on a company's long-term earnings power. Now, some examples of catalysts might be a change in management, which could lead to an unlocking of shareholder value. It could also be some sort of new or competitively superior product. It could also be a restructuring plan, which over the long term could improve the company's profitability and capital efficiency. Essentially, whatever the catalyst might be, they help us to avoid value traps. And that is really critical, because as value investors, it is easy to find a company that you believe has high quality and you believe is attractively valued. But unless it has those catalysts which are going to improve that earnings power over time, it's really just not something that's going to fit with our investment philosophy. So when we do find a company that has all the requirements of quality, attractive valuation, and catalysts, it will be purchased for the portfolio.
As co-portfolio managers, each of you brings something a little bit different to the table. Maybe mention some of the ways that you're similar and some of the ways you may be different, and how you ultimately work together.
Perfect. Yeah, I've spent 24 years now in the financial service industry. I started in investment banking in New York with Drexel Burnham Lambert and Kidder Peabody. I then spent a decade outside of the U.S. focusing on private equity transactions, primarily in Argentina, Brazil, and Mexico. I was an activist investor for a bit with Shamrock Holdings, and I've now been with Aristotle for 6 years, and its predecessor firm, of course, Reed Conner Birdwell. And Jeff?
Yeah, well, I've been in the financial services business for 14 years, and I've been a buy-side value investor my entire career. I got my start at what is now Oppenheimer & Company, where I worked for 5 years, during which time I became a chartered financial analyst. I then went on to join Reed Conner and Birdwell, where I worked as a research analyst on several long-only value equity strategies. And in 2007, Sean and I joined up and we designed and launched the international strategy, which now continues in its original structure here at Aristotle.
And it's these two different paths that we believe are quite unique in a PM team and have really led to what you've seen in terms of our investment success. We see the world through two different lenses. Jeff's a CFA. He's much more comfortable digging deep into the financial statements and understanding the nitty-gritty. I come at companies and look at them more from an operating level, being on the ground and hiring and firing and running businesses. And the combination of the two is really quite powerful. The fact that each and every purchase and sale needs to be agreed upon by both of us lends to some very rigorous debate and discussion. And with that, we feel it's a great filtering process to eliminate a lot of the companies that may seem like great investments, but actually aren't.
Talk a little bit about that analyst team and how you work together for idea generation.
I'll take that one. Well, first of all, we have regular meetings of the entire research staff in which all members provide an update on all of their recent research activities. Now, this could be news of recent corporate events, it could be details of an on-site company visit, it could be reviewing a meeting with management or an attendance at a recent investment conference. Regardless of what it is, our conversations tend to focus more on the companies that are currently held within the portfolios. Now, if an analyst feels that they have identified a potentially new investment that will work in one of the portfolios, then they will present it to the group. Now, oftentimes these new ideas are identified through an analyst's research of one of our current holdings, competitors, suppliers, or customers. But wherever the idea is generated from, It is presented to the entire group, and if Sean and I feel that it meets all three of the criteria of our investment process, then we will meet individually with that analyst to discuss that potential investment's merits. Now, if Sean and I both agree that the company is appropriate for inclusion in the international strategy, then and only then will it be purchased in the portfolio.
With respect to portfolio construction, how are investment decisions made and how do you mitigate risk?
As Sean discussed, we run a concentrated portfolio. The number of investments in the portfolio tends to average between 30 and 40. We feel that that's an adequate level to maximize the benefits of our rigorous bottom-up research while at the same time mitigating risk within the portfolio. We only invest in companies that have $2 billion in market capitalization in US dollars at the time of purchase. We also have an investment guideline that we adhere to in order to try and mitigate risk within the portfolio. That guideline is that we will never invest less than half, yet no more than double, the MSCI EAFE weight in any particular sector or country. Usually we focus primarily on those sectors and countries that represent at least 10% or more of the index. Now, this is a somewhat complicated guideline to explain, so oftentimes it's best to use an example. The United Kingdom represents approximately 20% of the EAFE index. So, according to this guideline, we will never have less than 10%, yet never more than 40% of the portfolio exposed to the United Kingdom at any particular time. We also tend to invest in new positions at an equal weighted level, which due to the concentrated nature of the portfolio tends to mean that new positions are roughly 2.5% to 3% at the time of purchase. Now, we consider that to be a full position, and we will only take full positions in new investments when it is warranted due to the fact that the company represents all three criteria of our investment process. Now, I bring this up to make sure it's understood that we don't spend our time trading around positions, trying to get our timing exactly right. Essentially, we're patiently waiting for that opportunity where a company is high quality, has an attractive valuation, and has several identifiable catalysts. And at that time, and only at that time, will it enter the portfolio.
Terrific. Thank you, Jeff.
Thank you.
Another question, do you have exposure to emerging markets, and if so, to what extent?
Yes, we do invest in emerging markets, but we do maintain a hard ceiling of 20% exposure to emerging markets within the portfolio. Actually, if you look over the history of the strategy, you'll see that at no point have we ever had more than 16% of the portfolio invested in emerging markets by headquarters. And currently, we only have approximately 2%. Now, the reason that this is the case is because Sean and I have found over time that we tend to add the most value by investing in global companies headquartered in developed markets that have long histories of successfully entering and operating in these rapidly growing emerging markets.
Great explanation. How much cash will you hold in a portfolio?
Well, it's important to recognize that we don't strategically utilize cash within the portfolio. Sean and I believe that it's really our job when people invest their capital with us to identify and invest in global, developed, international companies. And we feel that due to the concentrated nature of the portfolio that there's always sufficient opportunities to identify these types of quality companies regardless of the economic environment. Now, that being said, we do try to maintain a ceiling of 5% cash within the portfolio, but once again, due to its concentrated nature, at times it might creep above that level, but it will be transitional in nature and very short-term in duration.
Wonderful. What would cause you to sell a position in the portfolio?
Well, there are three primary reasons that we might sell a position out of the portfolio. The first is that it's simply fully valued and no longer trading at a discount to its intrinsic value, or all the catalysts that are going to close that gap between market price and intrinsic value have been exhausted. Another is that there could be another opportunity that we've identified within the universe that we would like to add to the portfolio, but simply we have to make room. And so that could lead us to have to sell a position in order to invest in what we believe is a better opportunity. And then lastly is that there's been a fundamental change within the company. If we feel that there's been a fundamental change and our original investment thesis no longer holds water, then it will also be sold out of the portfolio. Some examples that we've encountered over the years of fundamental changes could be an adverse change in the political or regulatory environment. It could also be an unexpected shift in the strategic direction of the company. Or it could also simply be the failure of management to execute on their operating goals. Regardless of what the fundamental change is, if Sean and I feel that our original investment thesis no longer applies and we no longer have a thorough understanding of everything that's going on at the company, quite simply, we will sell it out of the portfolio.
Thank you, Jeff. Let's change directions for just a moment here, now that we have an understanding of how the process works. Give us a few specific examples, maybe something that worked out in the portfolio and maybe something that didn't work all that well.
Absolutely. I think a great example of an investment that did work out for us was our investment in Hutchison Telecommunications. Hutchison is a Hong Kong-based telecommunications provider with a great collection of global assets around the world. Friendly management, transparent, accessible. They do a great job running their businesses. And we invested right after they'd sold their Indian assets to Vodafone. So they had a large accumulation of cash, and they were looking to deploy that cash. Given their past track record, we believe strongly that they would do a great job doing that, and we wanted to capitalize on that. And we continued to watch them. But what had happened is they came to the conclusion that prices were just too rich out there, and they did the right thing, and they were disciplined, and they returned their cash to shareholders. They subsequently sold their Israeli system at $1 billion profit. Again, a great example of capitalizing on a phenomenal asset. Then they spun out their Hong Kong asset, and we continued to own both for a period of time. The parent, which is Hutchison Whampoa, ultimately bought in the remaining non-Hong Kong piece at a 37% premium to market, so we were quite happy with that. And we eventually sold out of the Hong Kong piece when it reached our estimate of fair value. So that was one that had multiple moving parts. We held it for quite a long period of time, and it actually played out how we hoped it would.
And maybe an example of something that didn't work out very well?
Yeah, absolutely. Well, we have some of those as well. And the example that comes to mind is Esprit. Esprit is a great global company with a phenomenal collection of brands and a really impressive balance sheet too. Very solid, great company. We invested after the founding CEO had left and a new, younger, more aggressive CEO had come in to help lead a turnaround. The price had come down quite meaningfully, and there was quite a nice margin of safety for us to invest in this company. What we soon came to learn, which through the new CEO, is that this company had been underinvesting for a long period of time, and that had led to structural margins that were misleading, let's just say. They were earning EBIT margins or operating margins that were much higher than what were actually correct for this business. Once that became clear to us, the fair value dropped, but it was still meaningfully above where the stock was currently trading. We liked the company, we liked the brands, we liked the balance sheet. A lot of what we looked for were there. We just weren't sure that this particular leader was the right person to take us to the next level. Unfortunately, he decided to resign. This was due to he had a young family and he was traveling the globe a bit too much for his liking, so he left the firm. We continued to hold while we waited to see who the new CEO would be because we believed there was still quite a bit of upside left. However, when the new CEO came in, we came to the conclusion this wasn't the right person for the job. Great person, great track record, but wrong to lead this sort of global turnaround. So we decided to sell. Now that's an example of where we just didn't get it right, which will happen from time to time.
Sure. So what were the lessons learned? You
know, the lessons there are really that sort of structurally incorrect margins can last much longer than you would think, and sometimes they take a while to surface. We thought we got it right, but clearly it wasn't as good a business as we'd understood it to be.
Mm-hmm. Okay. As U.S.-based investors, how do you go about finding great international companies?
Well, Steve, first of all, we're living in an increasingly global economy, which is why all members of the research team take a global perspective to their research coverage. All the companies that we invest in compete in markets around the world, which is why it is crucial that we have a thorough understanding of their competitive landscape. It is this research that often leads us to find potential investments in international markets. Now, fortunately, most management teams have this same global perspective and actively seek to have a diversified investor base, which includes finding investors right here in the U.S. Now, it is crucial that any company that we invest in has a management team with whom we feel we can speak regularly in order to keep abreast of their current strategy and their operations. In fact, the vast majority of the companies that we invest in, we meet here face-to-face in our Los Angeles offices at least once a year. In addition, all the members of our research team regularly attend investment conferences both here in the U.S. and abroad, as well as conduct on-site company visits. In other words, we have found that in today's global economy, we're not limited in our ability to find great international companies simply due to the fact that we're based here in the United States.
Sounds like a solid approach, Jeff. Sean, how is the portfolio currently positioned? Any major under or overweights?
Absolutely. I think the key thing to understand before I answer your question is that the sector and country weights that we have are purely the result of a bottom-up process. We don't use a macro overlay. We take into consideration macro factors, but it doesn't determine how we structure and position the portfolio. So having said that, our biggest overweight is currently within the consumer staples sector. And within that sector, we have just some great global companies with phenomenal brands. A couple examples are Nestle and Heineken, which we talked about earlier today. We think of these companies as a great way to obtain exposure to many rapidly growing emerging markets, which provides a growth engine, but at the same time you have the transparency and you have the access to management in developed countries that really gives us the data that we need to make investment decisions. A lot of them have stable and growing cash flows, and many of them have an attractive dividend as well. In terms of an underweight, our biggest underweight is within the telecommunications sector, and that's directly a result of our inability to identify some great businesses as we define great high-quality businesses. A lot of these companies are now competing purely on price, and that's something that we tend to try to avoid. In terms of regionally and countrywide, our biggest overweights are in Switzerland and Ireland, and this isn't the result of our love for good beer or good chocolate. It's purely the result of the tax regime in each of these countries. And a lot of the holdings that are headquartered there, the bulk of their business and their operating profits come from elsewhere. They just happen to be domiciled in those two countries. The last regional underweight is Japan, and we've been underweight Japan since the beginning of the strategy. And it's not because of the lack of great companies in Japan. It's the lack of great investments in Japan. There are lots of great companies to work at. There are lots of great companies to buy products from, but there aren't as many investments that meet the three pillars, the three criteria that we look for as part of our process. Some of these problems are structural and long-term in nature, such as an employment for life mentality, an aging population, the cross-holdings that you see between numerous companies. But the largest problem that we see is a lack of focus on return on invested capital exceeding the cost of capital. And it's a discussion we don't have as much in that part of the world as we do elsewhere, which has resulted in an underweight in that part of the world.
Thank you. Now, let's talk about performance. How's the strategy done?
We're very proud of our performance. We've been doing this now for 5.5 years, and it's been an interesting period of time with many different market environments. But if you look back since inception, we've outperformed by more than 6% per annum. If you look back over the last 5 years, it's more than 5% per annum. And year to date, we're outperforming our benchmark by almost 2%. So having said that, if you look at our performance over the life of the strategy, you'll find that we're in the top 5% of our peer group, which we're quite proud of.
It's impressive. Why is that?
You know, it really boils down to a few things that we've talked about on this webcast here today. The first is stock selection, and it's really investing in great businesses around the world. We don't spend a lot of energy on businesses that we don't believe aren't great. The second is being focused. Running a portfolio between 30 to 40 holdings really allows us to dig in and dig deep and understand what we own. And the last part of the puzzle is our backgrounds. We come from a completely different backgrounds, and we see the world through two different lenses. And that enables very robust discussion and debate at times, and helps us sort of filter what gets in and what gets out of the portfolio. And that we believe is probably the single most important factor in identifying great investment opportunities around the world.
Terrific. Well, Sean and Jeff, again, thank you both very, very much for walking us through the international strategy. I appreciate you being here.
Thank you.
Our next webcast will consist of a conversation with our newly named co-CEO and co-CIO, Gary Lisenby. Gary may be new to Aristotle. He's not new to us. Gary is someone that Howard and I have worked with very closely for 20 of the last 22 years. We co-founded Metropolitan West Capital Management back in 1997 together, the last couple years of which Gary was most recently the CEO and CIO of MetWest Capital. So until that time, thank you very much for listening in and have a great rest of the day.